Hello and welcome to the Smart Money, Dumb Money Show. And I am your host, as usual, Keith Richards. I am President and Chief Portfolio Manager of Value Trend Wealth Management. And today is kind of an interesting show. I hope that you will find this interesting. You know, I've been in this business for literally 34 years now. And in a people business, you meet lots of people. And from meeting those people, you have lots of stories to tell. And I've lived through many, many markets. Even before I got into this business in late 89, really, I was licensed in 1990. So we'll call it from 1990. But before that, I even invested on my own, just like I'm sure most of you are doing. Most people watching this video are not professionals. And I was one of you for many, many years, investing on my own. And then I started in the process to become eventually a portfolio manager, which I am today. But over the years, as I said, I've met an awful lot of people. And I've got some stories of wonderful, wonderful people that I've met. Some have come and died. I've met some great friends and literally been through much of their life cycle. Some of my good clients and friends have succumbed to illnesses, and others have lived forever and had families who continue to deal with me. And I've got a number of clients that are third generational with me, which is really neat, because I started off with parents that had kids, and those kids ended up dealing with me and grew up, and now the kids of those kids are having have been introduced to value trends. So it's a great business, and you do meet some people that you really do appreciate. Now, one of the things you also come across, though, is, I hate to say it, some real interesting people. Let's just put it that way. I did have in the year 2000 a couple stories. I don't have charts to talk this through, but in just coming into Y2K, and some of you might remember, the year 2000 was supposed to be when all the planes were going to fall out of the sky, and computers were going to shut down. We were all going to lose our bank accounts. At least a lot of people thought this, because the computers had been set for the 1900s, and really didn't know how to deal with the 2000, the number 2 in front rather than the number 1 in front. And so there was all these predictions about, don't travel in air and you could lose all your money. So I had a number of people, of course, express concern, but I would talk them off the ledge, because, obviously, when we know of an existing problem, we can fix it. It's really the black swans that catch us by surprise. So, for example, the Terrorist Act 9/11, 2001. So that was, of course, a black swan. Nobody predicted that planes would be crashing into buildings, and there would be, the start of a new generation of worldwide terrorism. That kind of stuff you can't predict, but you can, if the clocks are going to change, and it's coming Y2K, then you can do something about it. So I used to tell people that, but of course, some people were just beside themselves. I had somebody literally pull their entire portfolio out and go into GICs, and 24 years later, and I think the market's gone up something like 800% or whatever in that period of time, and they missed it all. They just invested in GICs because they were so scared, and they never went back, because of course there's always something to worry about. But the better story is that I had a client who withdrew a whole bunch of money to a point where I wouldn't deal with them anymore, because we have certain limits that we will invest for clients. And this guy drew out a whole bunch of money, and it was just before Y2K, and he built, and I'm not kidding you, a bomb shelter, because he believed that Y2K would not only cause airplanes to fall out of the sky, but he also believed that this would invoke a World War III kind of situation, because nuclear bombs would be sailing through the air and all these things. So that's two of the non-chart orientated stories I can tell you, but I've got a couple of other stories, and I hope these two stories really help you understand that you've got to avoid crowdthink. You've got to avoid the herd. So I'm going to share screen, and I'm going to pull up a chart. And so this chart is that of oil. And the reason I'm showing you this chart is because it goes back to 2004, really, the left-hand side of the page. And back in 2000 and just before 2008, I should say into 2008. So I think it was around the summer of '08. Oil had risen absolutely exponentially. Now, I started getting technical signals that it was super overbought. So right around, I believe it was like July or August or September of that year, I began to sell out of oil, and this was coming into 2008. It was 2007 that I was doing my selling, and of course the market moved up after I sold. So I would have been selling somewhere in here. It seems to me I was selling around September of '07, and I had made some pretty good returns. You could see I had bought oil actually a number of years before as low as $12 a barrel, because there was a point that not shown in this chart that oil had crashed, and I was buying it between 12 and 15 bucks. And by this point, I had written it up to, it was something like 80 bucks at the time. Okay, right around where it is right now. And I felt that that move was pretty parabolic, and I had technical indicators and whatnot illustrating this. And I also recognized a crowded trade. So I was using some of my early sentiment work. I was not quite as sophisticated as I am today when it comes to sentiment, but I was using options ratios and stuff like that. And so out of the portfolio, I sold our oil stocks, or I began selling. It was lagging out. And I had a client at the time, late 2007, early 2008, and the market had, as you can see, risen further after I sold. And I remember we sold at a pretty sweet profit, but he saw it go up some more, and he calls me and he goes, "I'm transferring out." And just to let you know, as I said, 34 years in the business, and I almost never lose a client. Like, Value Trend delivers what we promise. We tend to tell you right up front how we're going to do things, that we're not trying to beat the market. In parabolic periods, we try to beat it by not losing, win by not losing. And we do that very, very well. We have beaten the market over time, but we've actually done most of our outperformance by not losing during the down periods. So that's an aside, but he said, "I'm transferring out." And I'm pretty surprised because I don't usually lose a client. So he said, "The reason I'm transferring out is because you missed the boat, or you're missing the boat." I think it was his words. And it's because oil was still going up. And I said, "Look, I don't remember his name, but let's call him Fred. Look, Fred, I think the market is overbought on oil, and we've made a lot of profits. So I really think there's a lot of danger in owning it from here." Now, these days, I do use trend following stuff a little bit more than just relying on the sentiment work. I these days would probably have bought it on the trip down, but I might have actually sold it pretty close to the same price, because I wait for a trend to break after I get a sentiment signal. Whatever the case, we're probably talking just a few dollars difference. And I told him, like, there's a lot of danger on this trade. It's going totally parabolic. And he said, "Well, I'm transferring out because I'm going to go to an advisor and I'm going to buy oil." And you can just picture, it was around here that he was going to the advisor who would load his portfolio up with oil. All right, so that's an interesting story, only because it illustrates how herd behavior works. And I've seen this in the FANGs in 2006-07, and I saw this in the AI stocks, which there's some repeats of the FANGs, FAANGS, adding a few like NVIDIA and a few others. But the idea is that everybody jumps on the boat, okay? And you've got to really be cautious. Again, there's 2017, 18, and you saw what happened there. And there's the recent AI move, okay? Parabolic, and you can see now, I'm sorry, this is oil, but the S&P chart had recently spiked and is beginning to round over. So oil, same thing, and I really shouldn't compare oil to the FANGs and tech stocks, but the patterns are similar in that things get overbought. So let's just take a look at another story. And in just after the 2020 COVID crash, we started loading up on oil. Some of you might remember that oil contracts for a very brief moment, and this is that moment, went to like a negative price. And that was because everybody felt that there wouldn't be any flying or traveling or use of oil in industry as the world shut down. And therefore the cost of holding oil in the storage tanks was going to exceed the cost of what they might get for selling the stuff. It was a real panic. They had too much oil on reserves. So oil went negative. It was costing oil producers more money to store it than because they couldn't sell it. Well, that of course was going to change. I mean, COVID was an event, just like 9/11 was an event, and these things eventually change. So we started buying oil. We saw it rise. We didn't know when it was going to rise, but we saw it settle out, break out, and we started buying it right in here, just coming into 21. And anybody that's been following my blog, in fact, clients that have been with me for the 20, 30 years will remember probably me selling the oil back in the 2007 period. Anybody that's been following my blog and any of the clients that are watching this right now will remember that in 2021, I started talking about how inflation was not going to be transitional. Do you remember that? I've only repeated it a million times since then. And I've also since then talked about oil and materials. And if you guys have been reading my blogs and watching my videos for any period of time, you know I've been talking about this stuff. So we were jumping on oil when it was dirt cheap. I was blogging about it, recommending it to you guys on my videos and blogs. And here we are. So it was a good opportunity. We've traded it, and we have sold out of it, and we've been buying back into it, and we think it's going to go sideways for the summer, but that's not what I'm here to talk about right now. I want to talk about another client that called me and said, I'm transferring out. And again, I think I get like one transfer out of a client every 5 to 10 years. It's been so few in my business that these guys stick out in my head because we're very careful to explain how we do things. We don't jump on the bandwagon. We do sell when there's danger, that kind of thing. So this person was more of a believer in what you would call ESG. And that was a big fad. You might remember it started 2-3 years ago, and it was really kind of propagated by BlackRock, but others have done it. And it circled around that you've got to buy companies that have good environmental ethics and low environmental impact. You've got to buy companies that have good social ethics that kind of circulate around the woke thing. And you know, I did a video on the woke problem a while ago and how it hurt companies by following that. And then the last letter is G, and that's for governance. And actually, it's the only part of the ESG thing that I really think actually is a good thing to look at, and that is, you know, don't become a Nortel and cook your books. So that's a good thing. But the other two, I mean, really, what is ethical social policies? I mean, is it really ethical to have a limited number of people that you can hire that aren't of a certain race or gender or whatever? Like it's you should hire by aptitude, not skin color or anything else. And yet a lot of these social policies these companies invoke are really quite almost like reverse prejudice. So it's not necessarily good for their bottom line. And we've talked about that in the woke thing. Same with the environment. Some of this stuff is fairly unrealistic. So he said he didn't want anything with oil in particular in his portfolio because it's evil. And he also only wanted ESG. Well, there's where he was telling me that, because we were loading up on oil and he didn't like the fact that I was loading up on oil. So he transferred out. There's oil since then. Now, you guys might be aware or maybe not, but I'm going to bring you back to another page. So I'm going to go back to share screen and I'm going to pull up this. So this is an example of a global impact mutual fund. Okay. And I've highlighted a couple things. Now, this is just one, and I'll show you a chart in a minute of other stuff that would fit into the ESG thing. But this is an ESG fund, and there's tons of them out there. But this is just a good example because it highlights how they have done it's a Canadian fund, so you can buy it in Canada. And their idea is that they want to seek to align their investments with their values and the areas of energy and environment, health and wealth being, all in an environment of inclusive growth. I remember Justin Trudeau saying inclusive and then becoming the least inclusive prime minister in history, the most segregating prime minister. And that's really sort of inclusive. What does that really mean? Especially when it comes to being a stock picker, because if I were to write a process statement for my clients and Valitron Wealth Management's equity platform, which by the way, we have statements, our bottom line is maximum return with as little risk as we can get, with an eye on risk impacted returns first and foremost. We have no interest in following a theme. All we want to do is make good returns for our clients without high amounts of risk. That's our goal. Okay, that's what I would want to read if I was an investor. But some people follow this theme and they just got to have, impact first, as it says here, screening process, impact on the environment, whatever. Well, that's interesting because they're thematic. So this is a thematic investment fund, and there's tons of them. So I'm not just picking on these guys, but the thematic exposure, energy and environment, are they being environmentally friendly? 69%. Health and well-being, maybe of their employees and whoever, 10%, and then inclusive growth. To me, that's the worst one. So 10%. So they're really, they go in and they actually have a process where they question companies on these factors and not on, are you actually going to make money? As a priority. They say, we're going to try to also see companies that make money, but it's really worked out well for them. What the market's done over the past 2 years. This is the Q1 report for these guys in 2024, and the market's gone up a lot, and they've lost 11%. So what I'm not picking on these guys, by the way. I'm sorry, I don't mean to be mean or anything, but I want to point out that some of these policies don't help you as an investor. I'm going to give you another, sort of reality check, and that is on a lot of this ESG stuff and on environmental impact. I've talked about this in other videos, but a lot of people aren't aware that beyond the fact that it may not actually make you any money as a stock investor, and that's really the purpose of you being here, but it also may not even be environmentally friendly. And this is a good example. So this is a lithium battery by RYOBI, or whatever, very popular battery used in blowers and hedge clippers and that kind of thing. We have one of these. We have electric one, we have gas one, and we have a plug-in one. And this is the lithium battery. So you can see it says lithium battery. Okay. And guess what other companies make lithium batteries? Well, companies for EVs, electric vehicles, companies for, all kinds of stuff, actually, lithium batteries. Well, a couple of things about lithium batteries. I've written about this in detail, so I won't go into great detail here, but the impact of recycling, and a lot of people just take the little batteries, say the watch batteries and stuff, and throw them out. They don't go to the recycling bin, and they wear out. And there's an awful lot of EVs, it's all over the news right now, that are literally, the batteries have run out because they bought them maybe 5-6 years ago. And it's so expensive that they're just literally either dumping them off at a used car dealer and they're getting next to nothing for them, or they're going right to junk because people don't want them. And the other thing is lithium batteries, almost 80, I think it's 85%. I did note this on a recent either blog or video, that the vast majority of lithium batteries are made in China. So this one says, I pulled it up for you, but you wouldn't see it. It says battery cells made in China. Okay, so they made this in China, and China is notoriously, in fact, the vast majority of their power to power their factories that make these lithium batteries are driven by, drum roll please, coal. So there's the whole process of, mining this stuff in China, making it using coal powered energy, and then recycling, if not disposing of this stuff, which happens constantly, the longevity of it, so I didn't mean to get into this too much, but I'm just talking about sort of thematic investing does not make sense, because you really need to think in terms of what's going to make you money. And I've talked about there is a move towards environmentalism right now. I'm in favor of it, of course. You know, I live in the country and have a cottage and all that stuff. I don't want the environment ruined, but I'm also a realist. And the reality behind this is that we actually cannot bridge the gap to the point of where we are carbon neutral without using fossil fuels. And the way that North American, more woke oriented governments are shutting this stuff down is absolutely senseless. And I have blogged on this. I'm going to write a big piece on this because I just read a very interesting piece in Larry McDonald's book called How to Listen When Markets Speak. And I highly recommend that book. And he interviewed a number of oil and gas experts and analysts outside of that industry. And they were basically just saying that we're so far away from the carbon neutral thing, and fossil fuels are here to stay. So instead of getting all wound up about it in thematic and ruining your portfolio, I suggest that you look at the actual profitability in the next few years, not 20 years from now, and make decisions based on that. Because if you don't, I'm going to have to support you through my taxes in your old age. And I don't want to do that. So my proposal to you is that consider your investment portfolio as a profit-making and investment return-making vehicle first and foremost before you follow any theme, no matter what that theme may be. You're here to make money. You're not here to make a statement. You want to make a statement, go to Parkland Hill, buy yourself a cardboard sign and march up and down. But if you're going to invest, your job is to make money, full stop. Anyways, there's my stories. A couple of people that made interesting phone calls and interesting decisions at exactly the wrong time, as well as a couple of people that built bomb shelters and thought planes were going to fall out of the sky years ago. So let's not get caught in the crowd, and let's not invest thematically. And I do hope this was of some interest and some enlightenment to you in your investing future. Thanks for watching.